Hi everyone, it's Grace. Welcome back to my channel. Hope you all had a great New Year's holiday. As 2022 starts, the biggest economic concern is the high inflation, which went up to 7% last December. I believe that it will go above 10% sometime between March or April, and it's really not looking good. I do hope that Omicron is the last variant and becomes like the regular flu as the vaccination rate goes up and the market goes back to normal sooner than later. So, for the first video of this year, I want to have a precise forecast of how the market goes in 2022. I repeatedly examined the data released last year and in January to have a better understanding of both the liquid and illiquid market movement. The Fed's policy is sort of under a microscope right now. Every little movement will stir up the market. So if you're holding both liquid and fixed assets and have some kind of financial plans, you need to pay close attention. So let's dive in and see the 5 reasons why I think the Fed is popping the liquid asset bubble in 2022. Before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. Number 1. High inflation cannot be curbed without hurting the economy. At a nomination hearing this Tuesday, Jerome Powell says that if necessary, the Fed will use more tools to speed up the rate increase and reduce the size of its balance sheet.
We have to achieve price stability, and I believe we will, and I'm confident we will. And again, it's not just a question of restraining demand, although that will be. Right now, we're stimulating demand with very highly accommodative policy. As we move through this year, we will, in all likelihood, we don't know the future, but if things develop as expected, we'll be normalizing policy, meaning we're going to end our asset purchases in March, meaning we'll be raising rates over the course of the year. At some point, perhaps later this year, we will start to allow the balance sheet to run off. And that's just the road to normalizing policy.
In fact, I listened to the whole thing to understand the exact position of the Fed. And I think the role of the Fed is really to stimulate the demand side of the economy, which is historically strong compared to the supply constraints due to COVID. Unfortunately, it's not effective at all in solving the supply chain shortage problem. So the current economic boom is coming at a cost of high inflation and unstable price. What I think the Fed really wants to do is to curb the inflation without hurting the demand. Or another way to put it is that it wants to reduce the inflation rate without causing a major economic recession. Is it possible? In my honest opinion, I don't think so. When we look at history, a high inflation rate almost always predates or is accompanied by a recession. The wish is good, but the past data never lies. So as the Fed starts to increase rate this March, we're going to see major drops in the stock market and crypto. Number 2, the Chinese market bust is over and a boom is coming. And the US market boom is over and a bust is coming. Let's compare the situation between China and the US for a little bit before we dive into the Fed rate hike perimeter. It's interesting to see that China and the US are going through completely different timelines. It's sort of jagged in terms of the boom and bust cycle. 2021 is a complete bust for China and a complete boom for the US. And this year, I believe the situation will be reversed. In China, because of heavy regulations from the Chinese government, industries including real estate, IT, the financial sector, the tutoring education, and even for cosmetic surgery, it was a complete massacre. What essentially punished these sectors are antitrust laws, prevention of Chinese companies from going public in the US, very strict lending rules, and things like that. So it's completely busted for the most part of 2021. And guess what the Chinese government is doing right now? The market has hit the bottom and it's decreasing the loan prime rate, or LPR, which is very similar to the federal funds rate, to increase borrowing and stimulate the economy. At the same time, the scorching hot US economy has reached its peak and the Fed is increasing rates to cool it down. So I think the economic cycles are both structured by the government of each country, and 2022 is going to be a reset year for the US. So that's the main direction. Number 3, the Fed is increasing the federal funds rate to curb the inflation, but doing so will also crash the liquid market. First, let's take a look at how the Fed rate hike influences the inflation rate. The The federal funds rate is an important and basic tool that the Fed uses to influence other interest rates, like the discount rate that banks lend from the Fed overnight, the prime rate that banks charge for clients with the best credit. Usually the more asset, the lower the rate. And like mortgage rate, home equity line of credit, interest rate for auto loans and personal loans, etc. So the hierarchy of how the federal funds rate influences all other interest rates looks something like this. Another important thing to remember is that what the federal funds rate really influences is short-term interest rates, and it has little impact on long-term interest rates. So let's take a look at this graphic. The federal funds effective rate is aligned with the market yield on one-year Treasury securities, which influences short-term interest rate. Its pattern is very different from the 10-year Treasury securities, which influence long-term rates like the 30-year fixed mortgage rate. So increasing the federal funds rate will reduce borrowing activities from both businesses and individuals. The cost of borrowing will increase and the business earnings will be less, therefore reducing the stock performance. So the excessive value in the stock market will be pretty much drained this year with repeated rate hikes. For those of you who hold stocks and crypto, beware of the first rate hike starting in March because it's time to get out. And here's another tricky part of the business. The Fed rate hike alone is probably not enough to reduce the inflation rate to the target 2%. And this leads to the next part. Number 4, the Fed also needs to reduce its balance sheet size and selling assets to achieve the target low inflation rate. Powell also states in a nomination hearing that for the later half of this year, the size of the Fed's balance sheet needs to be reduced if high inflation still persists, which we know for a fact that it will. But rate hikes are not going to be enough to curb inflation. One way to understand inflation is that the Fed pumps excessive cash into the market, which causes the price to go up. So other tools like reverse repurchase agreement and asset sell-offs also need to take place in order to reduce price. I made a video before about the Fed's reverse repo. You can click here to check out that video. So what reverse repo does essentially is to help reduce the money supply in the market temporarily. A permanent way to reduce money supply is when the Fed sells Treasury securities and mortgage-backed securities, which is the opposite of what the Fed is doing right now, essentially sucking the excessive cash back from the market. This measure effectively curbs inflation, but it also pops the liquid asset bubble along the way. Number 5. The economic boom and bust cycle is like the interflow of money between liquid assets and illiquid assets. I think one easier way to understand the market highs and lows is by looking at the flow of money between liquid and illiquid assets. In 2020 and 2021, the money flow direction is from liquid assets to illiquid assets, meaning from the stock market to the real estate market. And 2022 and 23, the flow will be reversed, from illiquid assets back to liquid assets, meaning from the real estate market back to the stock market. Right now, we're at a point where most people who hold stocks and other types of assets are parking their money in real estate as the stock market is about to tank. So here, I actually find something very interesting that will show a precise view of the pace of the market crash, aka when exactly will people start to sell properties? Because it's a very difficult question to answer. It's a graphic that shows the relationship between the federal funds rate and the difference of the yield between the 10-year and 1-year Treasury securities, which are reversely related, meaning that the higher the federal funds rate, the lower the yield difference. Whenever the yield difference becomes negative, an economic recession hits, which is represented by the gray bar here. I think what a yield difference represents is whether long-term interest rate is higher or lower than the short-term interest rate. When a yield difference is positive, the long-term borrowing interest rate is less expensive than short-term borrowing interest rate, which is what we usually see in an uprising, stable economy. For example, the interest rate of the personal line of credit that you borrow from the bank is usually higher than the mortgage rate. When the yield difference is negative, the short-term interest rate is less expensive than long-term interest rate, meaning that banks will create such a low rate for you to borrow money from a personal line of credit that's even lower than your mortgage. So you'll probably sell your property, pay off your mortgage, and get a personal loan. This is what's happening now in China. Since the Evergrande crash, the Chinese government lowers the LPR and pumps 1.2 trillion yuan into the market to boost it up. Banks and lenders everywhere in China are encouraging people to borrow money right now, and developers are just trying to get rid of the properties. As of now in the US, the money flow will stay in real estate market for quite a bit until short-term interest rate, which affect the stock market, becomes less expensive than long-term interest rate, which affect the real estate market. So one way to understand when the housing market will crash is by looking at when the yield difference between 10-year Treasury securities and 1-year Treasury securities becomes negative. So it's probably going to be somewhere between 2023 and 24 when the Fed raises the rates to the point where short-term interest rates becomes less expensive than long-term interest rates. This is when people will sell properties and move the money flow back to the stock market. So this is the most important chart that you should look at if you want to understand when exactly the housing market will tank. And I will include a link to the chart in the description below. So this is the important takeaway. Make sure to watch to the end. The stock market will crash. This is the last opportunity to move the money from the stock market to the real estate market. Use the stock as a collateral, cash out, buy a property, take out a mortgage, pay off the line of credit from the stock collateral, rent the property out, and sell off your stock holdings. Rental income will be the last supporting cash flow in 2022 since rent increase is still happening because of low supply of homes available for sale. So I hope you find today's video useful, and let me know if you have any questions in the comment section down below. And I'll see you on the next one.